Welcome back, all of you. Now we start with our next session on China in the post-COVID era, global and regional implications. The speaker for the session is Mr. Xu Sitao, Chief Economist, Deloitte, China. To begin with, I would like to invite the moderator for the session, Mr. Neelkant Mishra, Managing Director, Co-Head of Asia Pacific Strategy and India Strategist for Credit Suisse. Neelkant has been rated among the best analysts in India by the Institutional Investors and Asia Money polls. He is a part of Economic Advisory Council to the Prime Minister and has been an advisor to several government committees like the 15th Finance Commission, the FRBM Review Committee. He is a widely followed columnist in prominent newspapers and newspapers and magazines. Neelkant has worked on metals and mining, Indian pharmaceutical sector, Taiwan IC design, semiconductor foundries, and Asian tech strategy research based out of Mumbai, Singapore, and Taipei. Neelkant is a gold medalist from Indian Institute of Technology, Kanpur, graduating in computer science and engineering, and a distinguished alumnus award winner. Neelkant, the floor is yours now. Thank you so much.
Thank you, Monica. I welcome to the session. I'm absolutely privileged to moderate this session with Dr. Xu Sitao. He's the chief economist and partner of Deloitte China. He spearheads Deloitte's economic and industry research. Prior to Deloitte, he was chief representative of China and the EIU forecasting director at the Economist Group from 2004 to 2014. He has worked for S&P in Singapore as the economist for Indonesia, Korea, and Thailand, so he can give us quite a regional and global perspective. And then he's also worked with leading banks like Standard Chartered, SocGen, and ICBC as the Asia chief economist. He has written and he writes for Yale Global Online, the Wall Street Journal, Financial Times, all the leading journals, Caixin, Caixin, and the 21st Century Business Herald. He's also a very sought-after commentator by CNBC, Bloomberg, CCTV, and other TV shows as a commentator of China. He also consults with multinational corporations who invite them to their boardrooms. And he's actually also a board member of various large companies. He holds a BA in economics from Peking University. He's a master's in economics from the University of Connecticut and an MS in finance from Boston College. He was a visiting scholar at Hoover Institution at Stanford in 2012. He's also a guest professor at the School of Economics and Management of Tsinghua University. Welcome, Sitao.
Thank you.
Absolutely. A pleasure to moderate this session. The way we run this session is Sitao will run the presentation for the next 30 odd minutes. Then we have some questions which I really want to ask, and then towards the last 10 minutes, we will open up for audience Q&A. The floor is yours.
Okay, thank you very much. What I would like to do for the next 25-30 minutes, really just to focus on China for several reasons. Not only China is driving regional trade, the price of global commodities, and also because China is in a very different business cycle from the US and other leading economies. And global rates are up, but China will continue to cut interest rate for various reasons. So I think that's really have certain ramifications for global economy and financial market, and also fits the theme of this week's conference, disequilibrium. Of course, in post-COVID world, there's no doubt the mutual trust would become a more challenging issue beyond geopolitical factors. So that's really the big picture. So if you turn to the next page, what I would like to do is to take a step back, just look at China's growth model, because people talk about China, export-oriented, strong government, and so on and so forth, right? So what's the essence of China's growth model? So I have given a few attributes. And first of all, China has been doing what Japan and the newly industrial economies have done, and relying on exports to drive growth with a relatively undervalued currency for most of the time. So today, fast forward, Chinese economy is on the verge of surpassing the US, and not quite, maybe in 10 years, but China will get there. But before China surpassing the US, China is already the largest trading nation, and between number one and number two, that gap would continue to widen. The other, the important ingredient of China's secret is infrastructure. So clearly, policymakers have planned a long game, because implicit assumption is once you build a temple and your customer will arrive. But of course, I mean, this cannot be true forever. We are in CFA conference, cash flow is very important. You cannot just say, okay, eventually people will arrive. But the reality is, I mean, today, China is still a relatively poor country per capita GDP, just over 10,000 US dollars. So still in catch-up phase. Now, the third element is slightly controversial, because for emerging market, periodically you go through balance payment crisis and you have to deal with bubbles. So how China is dealing with that? Clearly, I think China today is very different from Japan yesterday. Early 90s of last century. So when you have a bubble, you really don't want to prick the bubble, because the consequence could be quite painful, right? Balance sheet recession in Japan. When Japan did that, Japan was already very rich, but China is not that stage yet. So the third element, I would say, Chinese leaders have been are not really being dogmatic, right? Really, because in the end, every country has to pursue its own growth trajectory. Now, the fourth element is China's urbanization has been progressing, but China won't do that in one go, because the urban problems, social issues really cannot be coped with. In the end, China is not Northern Europe. But at the same time, China clearly does not want to take other emerging markets approach in dealing with urbanization. So this is a controversial, right? This is no right or wrong. But I would say those are the key element of China's growth model. So if you turn to the next page, so what are the key assumptions for China's growth model to be sustainable? I have listed 3 assumptions. The first assumption is external demand is unlimited. This was true last century. This was true before global financial crisis, but clearly is no longer true. Otherwise, we won't have the trade war. We won't have populism in Europe and everywhere, even in China, right? So that's the first assumption. The second assumption, in order for China's growth model to be sustainable, because socialism really has failed in most countries, but central planning in China has failed in a more spectacular fashion by the end of Cultural Revolution. So I would say the rejection against the central planning, if it's coming from bottom up, that is actually more lasting. So you may want to, really go to YouTube to check out this latest movie made by this English lady. I mean, the picture in the middle is about the success of the Chinese economy. It's also about the social cost of China's growth. An American factory that was well known, it's about a Chinese billionaire setting up this factory in the middle of nowhere in Ohio. So that has demonstrated the entrepreneurship. I'm sure many of you have read a novel, White Tiger. I mean, Netflix has turned that into a rather interesting film because the movie or the novel was based on this Indian self-made entrepreneur's letter to Chinese Premier Wen Jiabao when Wen Jiabao was visiting India many years ago. So the reason I put this picture on this slide is if you study Chinese history, even from Qing Dynasty, when farmers were rebelling against emperors, there's a saying, how can one's birth prevents us from becoming princesses, barons, generals, and ministers? So there's no doubt. I mean, China has a long way to become a traditionally defined democratic society. But I would say there is a high degree of social mobility. So next page, please. I'm very anxious, aware of time management. So let's talk about the Chinese economy. I would like to give a recap of what China did last year. Last year was easy. There was no growth target. Government never said that. But everyone in financial market was guessing should be around 7.7, 7.8. In the end, it was 8.1%. So this target was being achieved so easily. But of course, base effect was important. 2020 was a lousy year. But the government has purposely kept powder dry. So by summer last year, central government was still running a fiscal surplus. The exchange rate has been appreciating beyond almost everyone's expectation. So you had a tight monetary policy and a tight fiscal policy. During economic recovery, so very economies could afford to do that, and China did that. So I would say, economically speaking, 2021 was a good year. But of course, we also attribute that to luck, because when global supply chain was being disrupted and China was in a relatively favorable position. So next page, please. Now, lessons from China's recovery and unintended consequences. So first of all, China's strong recovery clearly was attributed that to this strong commitment to restore investment and production at all cost. So is that good or that is bad? I mean, for China, I would say it's more positive than negative, because in the end, unlike developed countries, you need companies to ditch out salaries and so on and so forth. In the end, China is not the United States. But of course, there's also a cost to be paid. This is a controversial element on zero-case policy. So by talking to friends in Mumbai, I was very encouraged to know antibody would reach 90% in India by March this year. So if the whole world is willing to live with COVID, what will be the exit for China? The answer is, I do not know. But that is indeed the cost. China also, earlier I talked about tight monetary policy, tight fiscal policy, because there was a recognition in China. What China did in 2008 was wrong. the large stimulus package resulted in unperforming assets and leverage. So, and as you know, it's easy to build up leverage. It's never easy to deleverage because politicians, society in general, people just do not have the appetite for doing that. If you ask people to tighten up a belt, unless you are really being forced to do so, and quite often only foreign creditor will allow you to do, could force you to do that. But China is never a debtor. So this is a cost for China. It's not threatening in the short term, but in the long run, it could be a problem. In the earlier session, the lady talked about the really digitization or digital transformation, almost a buzzword in past 2 years. And China's digitization clearly is very, very impressive, but there's also a cost. The cost really on social side, because once we no longer have COVID, do you think I don't need to carry my mobile phone without health code? The answer is I do not know. Next page, please. So China in 2022 and beyond, I'm going to speed up, really focus on China this year and what does that mean for the rest of the world. So this year, our official forecast is 5%. But I think that target, which is implicit one by the government, is quite challenging. Why is that? Because in past many years, property sector investment has been growing far greater than the pace of GDP growth. That was true until summer last year, before the collapse of Evergrande. Going forward, I don't think that's going to be the case. So it doesn't take a mathematician to figure this out. If investment growth in property sector, let's say, is 1% or 2%, which is still very generous this year, then it will be very difficult for GDP growth to reach 5%. This is just simple math. So the key question this year for China is we really need to do the cost benefit analysis of zero COVID policy. We also need to look at policy side. Last year, investment community clearly was perplexed by a number of policy initiatives, tutoring industry and technology and a platform. It really goes on. So there's clearly an issue of communication, but in the end, I think investors would like to know the objective and the process, so on and so forth. So I think that's going to be a major issue. So in the end, cyclically will be the growth driver to replace property sector. That's a big question. So that is why for China, monetary policy has to be loosened, and the fiscal driver has to be utilized in a more effective manner, almost in a bold manner. And I would even say exchange rate adjustment perhaps is needed, not because Chinese products are less competitive, but rather the fact slightly more competitive exchange rate will make monetary policy more effective. Next page, please. So if we put all this together, what does that mean for the rest of the Asia and India? I'm going to keep this simple. So let's say Chinese economy is growing slightly below 5%. Let's say zero case policy will stay for the rest of years. Let's say China will cut interest rate, will adjust the exchange rate. So Asia, I think industrial part of Asia, South Korea, Taiwan, they'll be doing relatively better. Those economies who are relying on Chinese tourism, Thailand will be prime example, I think will suffer. But of course, by no means the impact will be detrimental, because one big picture this year is RCEP, this regional trade, a framework would drive investment from China, South Korea, Japan to ASEAN regions. So overall, ASEAN will be a big winner. But on zero case, I think the poor part of Asia will be affected negatively. So monetary policy divergence, this is something we have not seen before. So let's say Fed is raising interest rate 3 times. Let's say China is cutting interest rate 3 times. And the interest rate gap between China and US at the peak was 2.5%. Let's say by the end of the year is 0.5%. So I think exchange rate adjustment is indeed needed. I don't think that's something financial market has taken into account yet. So the final point is China picking a significant risk. This was something raised by Morgan Stanley and other investment strategists. Personally, I don't think so. I think at today's China, you can live with 4% growth rate, even 3% growth rate. But I think policy risk or policy errors is something China has to pay more attention. So maybe I should stop right here and just really taking questions from you, Nikan, and also from your audience.
Thank you, Sitao. You've left, you've given us a very good sense of all the moving parts, and the ground is quite fertile for some, I would say, a number of questions. And so let me start off with a question that you sort of hinted at. So you talked about currency adjustment, and this is something that we in India also are sort of trying to wonder, that there was this long period of multiple decades where inflation differentials were the reason why people thought that the Indian rupee should keep depreciating. What we are seeing now is that for several months, the US inflation is actually higher than Indian inflation. And so the question to ask is, if the Fed does what is necessary, if higher inflation in the US further erodes their competitiveness, it expands their current account deficit even more, what does it do to currencies? And you're absolutely right that if Chinese currency appreciates or depreciates, it I think affects all of us. So if you were to predict or at least see a trend, in what direction do you see the CNY USD CNY headed?
Okay, the short answer is US dollar goes higher, and maybe US dollar would go a lot higher in 2 years' time for the following reason. First of all, you already laid out very clearly about inflationary pressure in the US. There's no doubt about that. I think even financial market is getting tired of the word of transitory, right? I mean, this is just becoming semantic. For China, there's no inflation, right? Because economy is slowing, and right now we have some issues dealing with the property market, right? So that's actually deflationary pressure. Commodity prices are very high. So if you just take very simplistic approach, let's say you have one big Chinese company, steel mill, you have one big Chinese company making machinery tool, then you have companies making consumer product. Clearly, because competition, the more you are closer to final users, the ability for you to pass on high input prices will be reduced, right? One, because competition. Secondly, because the more you are away from upstream, chances are you are not a state-owned company and you have less access to state banks financing. So the issue for China, in my opinion, is not to worry about so-called imported inflation, is to deal with margin erosion, which ultimately be translated into non-performing assets. So this is something China, but of course, Asia has experienced that in 1997, 1998 in a very painful manner. But China today is not Thailand in 97. China is lending the rest of the world money. China is not borrowing money. RMB exchange rate is strong, but I wouldn't say it's too overvalued, right? Maybe it's fairly valued. And this year's current account surplus, based on my estimate, is still going to be, let's say, 1.4, 1.5% GDP growth. But last 3 days, and the financial market did not react to central banks' monetary easing, right? The market did not rally. So if the market didn't rally, equity market was saying, you need to do more, right? That's just simple reaction. So I would say for China, exchange rate adjustment has nothing to do with competitiveness. It's about making your monetary easing more potent. Now, in the long run, this is something we have to deal with in China. In the long run, we have to deal with this, some of the bubbles, property bubbles and this, right? The best way to deflate the bubble, to deal with the bubble, is to make a big bubble, smaller one, smaller bubble, no bubble. So how do you do that? You need to have higher income, you need to have slightly higher inflation, right? Because otherwise, debtors will be in too painful position. So exchange rate adjustment will be the consequence of that in the long run. So dollar would head higher.
Yeah, that's quite fascinating. So if the RMB, the CNY depreciates against the dollar, I think then the regional economies would also feel then tempted to target further devaluation of their currencies just to stay competitive with China. You're right that this doesn't affect Chinese competitiveness as much as the margin expectations of companies.
So,
but
I mean, what we have seen in Asia today, right? This is very similar to Europe prior to the introduction of euro. So Chinese currency is behaving increasingly like Deutschmark. So other currencies already packing them to CNY. I mean, really, it's quite evident, right? So if you look at New Taiwan dollar and Korean won and all this. So, but none of them right now, I would say, is particularly undervalued. I mean, New Taiwan dollar is all-time high, my God, at 27 against US dollar. Yep. So for them, just to give back a little bit of gain, I think that's okay.
Understood. Moving to a different question, which I have been very curious about, is the persistent weakness of Chinese consumption. So, so one would have expected that with the workforce starting to shrink, and so labor gets more income, that and the government policy is also to shift from investment to a consumption-driven economy. And this has been the theme for the last 5-6 years. But remarkably, when we draw these trend lines, so there is a 10-year trend line for Chinese sales, which of course versus that there is a significant weakness. There is a much weaker 5-year trend line, and the current sales are even weaker than that. So would you attribute this just to the COVID-related restrictions, COVID-related uncertainty? So say in the 6 months, if that disappears, the Chinese consumer feels comfortable enough to consume again? Or do you think the roots are much deeper?
Okay, so the definition of a Chinese consumer is tricky, right? So if you just define Chinese consumer as one entity like the rest of the world. Clearly, consumption GDP ratio has more room to be elevated. How do you do that? There are a number of ways to do that. First of all, you need to raise income of low income household because they consume more. Secondly, you need to increase healthcare GDP ratio. In this part of the world, North Asia, we are actually the only country without universal healthcare, right? So clearly, maybe we should do that at some point. Now, investment in education, there's also room for improvement. So overall, I think there's no reason for consumption GDP ratio in China not to reach 60% in the medium term, right? Now, Chinese consumers can also be divided between older consumer and younger consumer. Older like me, maybe younger like you, or even younger than you are. So if you go to major cities today, go to nice restaurants, chances are the patrons are all young Chinese. If you go to a parking garage, only young Chinese are driving nicer cars. Why? Because older consumers, they still have the memory of the past, right? This childhood trauma. So for younger ones, life has been, my God, S-curve. And besides, Chinese, they tend to think the biggest joy is for your next generation to have better standard of living. That's why I always say this to my team members. The more money you take from your parents, the more joys you give to them. So this wealth transfer also making young consumers more confident. That explains luxury goods market in China. So, so to answer your question, first of all, if we define China as one consumer, consumption GDP ratio can be raised. Now, if we define China as younger ones and older ones, this wealth transfer won't stop. So which means whether you look at auto market, luxury market, and all this, chances are they will continue to go from strength to strength.
Thank you. That's a very important nuance you brought to the discussion, which is that there are intergenerational issues.
Yeah.
There are income quartile issues. So we need to get the lower income workers get more wages so that their aggregate consumption goes up. That brings the elephant in the room, demographics, right? So the government is clearly, and at least for outsiders like us, a lot of these decisions against tutoring classes, against property, because expensive, people won't have kids, seem to have been triggered or at least accelerated by this precipitous drop in the birth rate in China in 2020, and I don't think 2021 was much better. So clearly the government is at it, and knowing the execution skills of the Chinese government, clearly, I mean, they will deliver, or they should be able to deliver. But for the next 15 years, 20 years, the industrial workforce or the workforce will keep shrinking. What does this mean for the Chinese current account? What does this mean for the property market? You rightly said, I think it's very hard to see it growing very rapidly from here, whatever be the stimulus the government gives. And what does it do to the industrial output, which actually for good reasons is the mainstay of China's exports. On the services side, their exports are a lot lower.
One-child policy was introduced early 80s, last century. So clearly, right now, the government would prefer couples to have 3 kids, right? It's easier said than done, because if you look at countries like Japan, South Korea, Singapore is another example. Once a country reaches a certain stage, then people just, the willingness to have kids just being reduced, right? So China right now urban China is going through that phase. So I don't think the government can really move the needle, right? So then the question is, will China exhaust so-called democratic dividend right away? I think that's too early to say. Just to give you a few examples, right? First of all, at the beginning, I made a point. Urbanization has been proceeded in a controlled manner, right? So, which really means it's a two-tier society, urban China versus rural China. Is that fair? Clearly, it's not fair, right? Because in urban China, we enjoy certain amenities which is not available to rural China, right? So I think urbanization still can reach maybe 70% in the long run. So that would mitigate demographic pressure. Secondly, retirement age. This is a legacy issue from Soviet Union. Women retire at age 55. Men retire at age 60. Why? Because for poor countries, women die young. But in today's China, urban China, clearly women live longer than men. But that policy still being kept. Why? Because any policy would benefit someone. It's difficult to change that, right? So, so clearly we need to adjust retirement age. What else? I also think there's a room for improving education, rural education, particularly. So China can still do many things. So I'm not going to talk about tutoring industry. I don't think tutoring industry really has any significant impact, positively, negatively, on birth rate.
Okay, no, that's good to know. At least one issue discarded. So from the perspective of near-term growth, I think you highlighted some very interesting points, and I think they're very appropriate and for all of us to mull over, which is that in 2021, China was conserving the policy space, right? So on the fiscal and monetary side, it was conserving fiscal space, and that allows it much more macro freedom in 2022. Now, it will be interesting to see. So the monetary side, I think, has started to happen, and you rightly said, perhaps we need more. We need also to see the CNY fall a bit. But on the fiscal side, what do you think will be the shape of the government utilizing this space to push it closer to the target of 5%, even if it doesn't get there?
Okay. So first of all, due to historical reason, land auction has been the main source of local government's revenue, right? So we know that game is over. It's not going to happen, right? So local government cannot borrow money through land sale anymore. So they go to central government. So we need more money from you. Well, central government getting money from local government to begin with, right? So big picture for next 5-10 years, you need to have a different setup between central government, local government in terms of responsibility and revenue. I mean, this negotiation will take many years. It's give and take, but clearly central government has to give up more. So that is a big picture. Secondly, I do think you need to help those industries, smaller ones, who are being hurt by COVID protocol and high commodity prices. And for big ones, you don't have to worry, right? For big ones, the higher iron core or copper prices will be automatically passed on to the customers, right? So that's something I think subsidy and reduction of fees could be more aggressive. And also, I mean, right now, COVID has changed people's definition, right? So at least for next a few years, no government in the world would be seriously tightening up the belt. So it's like when we look at high blood pressure, it's no longer 120 over 80. It's going to be 150 over 100. So the definition has been changed. So I think China should be more relaxed about fiscal policy.
Yes, so I think the critical issue is that fiscal policy, because of what happened in 2010, 11, 12, at least for the world outside, has been associated with a lot of infrastructure spending. And so the question is, as the government tries to stimulate growth, and this relaxation that has been given towards late 2021 for local governments to borrow more, because that had also been tightened. But is that a signal that there is a mandate to go ahead and build more infrastructure again?
There is a temptation to do that. For example, in the area of related to new energy, right? So yes. Nuclear power stations, for sure. 5G stations, for sure, right? High-speed rail, I'm not too sure. I do think the government has learned the lesson in 2008, 2009, because in that period, money was chasing project.
Understood. Now that's actually very clear. So on that count, I think with about 15 minutes to go,
sure.
Let me open up, and I have a long list of questions.
Sure. You can consolidate them. You can even put in your own editorial comments. Sure.
So Monica, how do I open up for audience Q&A, and how do I get to see the questions?
I think I have seen a slew of them in chat box, but maybe you know your audience better, so maybe you can actually consolidate some of them, so I don't have to sound repetitive. But you can ask me anything.
No, that's great, but unfortunately on my Zoom, I'm not able to see the audience questions.
Yeah, it should be a chat box. There is a chat box.
No. There is. It is quite possible that I'm not able to. Maybe you could pick up a few that you would like to answer. And
Sure. I'm just reading, right? So here's someone. Will China's success lead to disequilibrium in the phase many have in democracy as a right way for government? Okay. I think the answer is yes, because I mean, in past, when you look at countries or economies, normally when they reach per capita GDP of 8,000 to 9,000, so you have some political changes. Example would be Seoul, 1998. But clearly China is following a different trajectory. So I would say the success in China has reinforced most Chinese confidence in central government. I would also say maybe culturally there's a higher degree of. I'm sorry?
Sorry about that.
Oh, okay. I would say culturally, I mean, Asia in general, there's a higher degree of tolerance to a so-called corruption. I think maybe most Chinese they feel the most important yardstick for civil servants is whether he or she is more capable, right? So I think, you know, all this have resulted in whether you call that a disequilibrium or not. I think in the end, people in China are practical lot. So that's how I answer this question. The next question, well, because you know, you said your office is binding, your compliance is so tough, is binding your access to chatbots. So the next question is why China is such a closed country and why policymakers keep regulating the flow of information when they are trying to lead the world in terms of growth. Okay, so why China is a closed society? A few days ago, when I was listening to this podcast, I think really McKinsey podcast. So someone was saying, if you right now standing on the street of Shanghai versus Tokyo, which society is more open, right? So, I mean, if you go to any supermarket, you'll be surprised to see the number of foreign brands in Chinese shops, right? So I wouldn't say Chinese society is closed. So the question is why essentially media are being regulated. So I would say because the society is so large and maybe many people do not have the capacity to be fully informed. So I think so I think essentially you need to divide society into two parts. Policymakers, they need to be informed, right? They need to, because they cannot live in illusion. And for rest of society at large, maybe there should be certain control. By the way, we see the same thing in some other societies. But then the question is, when you have social media, whether you could have the situation less informed people's opinion may affect informed decision makers. That I do not know. So I prefer not to answer on this forum. It's a question I have raised. So,
I'm able to see some, so I've logged on from my phone, so I can see some of the questions now. So, so there is this, shift of manufacturing out of. So this is clearly from an Indian perspective, not perhaps as important for China immediately, but there is this China plus one strategy that we keep hearing about, and I must be honest that we are seeing good traction in that, right? So in several sectors, companies in India are saying that global customers are wanting to create alternatives to China.
Sure.
That's creating opportunities in India. So how much of that is just the result of the trade wars? How much of that is actually a drop in the workforce and a shift? Because, I was looking at some CIC data that the industrial workforce in China has shrunk by 30 million since 2015 as people have shifted to services. And there is this whole, I don't know if you've seen that Japanese research document which says that China cannot afford to let people out of agriculture because of food self-sufficiency issues, that agricultural productivity cannot rise very rapidly. So the number of people in agriculture needs to be contained, and therefore, as demographic pressures show up, people want at $10,000 per capita, they want to move up to services, then there will be less industrial workers. And this could actually even worsen over the next 10 years. So how do you see this shaping up, and how is this an opportunity for ASEAN, for Vietnam, for Bangladesh, for India?
Yeah. So first of all, as cost is rising in China, inevitably certain industries will be migrating from China to Vietnam to Indonesia, sneakers alike. Even some of the mobile phone we have seen, Samsung has done that in Vietnam. I think this would continue, number one. Number two, due to trade war, not only people talk about China plus one, also people talk about onshoring and the decoupling. So whenever people talk about that, I often ask people, would you give me your definition of decoupling? So if I ask people, and 99% of people literally do not know how to define decoupling, but then they say, let's talk about decoupling. I say, how would you define your decoupling? They say, well, we need to talk about decoupling. So I think this is something people would continue to talk about, but very few people are putting that into action. So if we look at all these big companies, we need to understand American company, they want to get into China's financial service and healthcare industry. For European companies, they are working with China. They are also competing with China, Siemens, ABB alike. Japanese companies, strange animal, because in almost every field, their product are so exquisite, but in certain area, no matter how exquisite the quality is, no one wants that. For example, digital camera. So that's why when people say, my God, Canon is shutting down factories in China, I would say, sure. It has nothing to do with the cost. It's just demand just being replaced by smartphone. So that's something Japanese companies have to deal with. So this is a big picture. So I think for now, people will continue to talk about decoupling. Agriculture, food sufficiency, I'm not too sure is as important as it was before. There was a debate on food safety 30 years ago when China started economic reform. So this senior policymaker was asking a well-known Australian economist, how could China achieve that? So the answer from the Australian economist was easy. If you want to remain as a poor country, then you can achieve self-reliance. So that's the answer.
Oh, that's quite fascinating because one of the things that has happened, because in the last year and a half or so, is at least in the global agricultural markets, one reason for prices to go up so much has been that the Chinese are building inventory, that in corn, in soya, in rice, wheat, that and there is a lot of inventory building happening in China. Do you think that is just a cyclical process, or do you think there is a bigger strategic focus on ensuring self-sufficiency?
So urbanization will change people's diet. So the meat consumption will go up. Dairy consumption will go up. This is still early stage for Chinese consumers. And the Chinese consumers will have coffee, will have more seafood. So basically the rest of the world, which is catering China's demand, broadly speaking, I separate them into hard commodities, that's iron ore from Australia, soft commodities, Canada and Argentina, and somewhere in between. So in the long run, I think soft commodities will have more room for growth.
Okay, that's actually very clear. So and I think we have time for one more question. So let me link it to the one on stock markets, given that this is an investment conference, and let's not keep it too abstract at economic level. So on the stock market side, there's one very personal question as to, are you bullish on Chinese equities and what percentage? And I'll leave that to you to whether you want to answer it or not. But more importantly, from a regulatory perspective, is the delisting of Didi by the Chinese regulatory authorities, is this just the beginning, and will we see more delistings happen NASDAQ and more listings happening in Hong Kong and Shanghai and Shenzhen?
I think depends on sector. If I'm not mistaken, on the latest development that Luxin Coffee, that's China Starbucks, is planning to be relisted in the US. Didi is a different story because its size is so massive. And also it has touched upon some of contentious issues, data security and so on and so forth. So I think for companies in that space, secondary listing in Hong Kong will be a necessary move. But of course, in the short term, and Hong Kong market won't be able to compete with the US market in terms of the size. So there is a valuation gap. But in the long run, I think such a valuation gap will be narrowed.
And particularly given that the opening up of the Chinese financial markets, actually, at least the objective is that over time there is much greater liquidity in Shanghai itself, and therefore it can absorb much larger listings and the listing of much larger companies.
Yes. So I think on capital market, first of all, can you imagine if China does not have Hong Kong? So China has been outsourcing the function of capital market through Hong Kong. So I would say if there's no Hong Kong, surely the Chinese economy would have been less successful. So that's the first point I would like to make. Second point I would like to make is liberalization of China's domestic Asia market has been a work in progress. So what be the next step? So I think next step you need to take really more than baby steps in implementing registration system. So ultimately, it's going to be chosen by investors, right? I think India has done that extremely well. China has a lot to learn from India. There's also something China can learn from India, because there's no reason for all these multinationals, whether BMW and Volkswagen, Toyota, Honda, Honeywell and Procter & Gamble, not to list their China business in China, right? So, I mean, the direction is very clear, but you just need to take more than baby steps the next few years.
Thank you, Sitao. This was, I could just go on and on with the questions. Yeah. There is so much we need to understand.
Thank you.
But, and so it was an absolute pleasure.
Your pleasure is mine.
No, erudite responses, very patient answers. We've learned quite a bit. So on that, as we close the hour, I think it's time to thank you and the audience, and wish you well in the future. And I look forward to interacting again. Thank you.
Thank you.